Only watch this video if you want to ace on your test. And I'm going to pretend it's an actual test, so I'll go faster than I normally do. Here we have adjusting entry. Okay, we need to do adjusting entry. And everything here, the information we have here is on adjusted balance, and we need to do the adjustments. So as usual, I already have my template set up. So A, it says fees earned but on bill on April 3rd were $10,000. So that means we have earned fees, but we haven't billed. So we are going to bill the fees. And when we earn fees, become fees earned. So that becomes credit in our fees earned. And we are waiting to receive the money. So that becomes account receivable. So we have this one here. $10,000. And that'll be the same on the credit hand side or on the right hand side, $10,000. Second, supplies on hand on April 30th were $81,500. So that means this is what is left. So how much did we use to find our supplies expense? So we need to find our beginning minus what is left. So our beginning is $21,600, which is right here. So we take the beginning minus what is left. That is our supplies expense. That supplies that is used. Okay. So we have here 21,600 minus 8150. That is supplies use, and that will be our supplies. That's reducing our supplies account as well. C, depreciation of equipment estimated to be 13,800 for the year. Okay, so that is straightforward. Depreciation expense is 13,800. And then it goes to accumulated depreciation because that reduces the book value of the equipment. B, the balance in on end fees represent, okay, so that's the balance in on end fees. That's what we had right here, 24,000. That means we have collected the money, but we haven't done the work. But only 19,000 were provided, so that we have earned $19,000. So that becomes our fees earned. And then we're going to reduce this same amount by 19,000. So if this is credit and we are reducing it, it will become debit. Okay, we'll reduce it with debit. So 19,000. And then the same on the right hand side for fees earned 19,000. We have earned 19,000. Unpaid wages, okay, so we haven't paid this, so we need to pay, so that becomes wages payable. And wages, every payable is a credit. Okay, it increases with credit, okay? And then because it's a wages, it becomes wages expense. So we are going to do the same here. Wages expense is a credit, and it's a debit. Wages expense always increases with debit, so 1770. And then we're going to have the credit on the wages payable, so we have to pay this. And you can see left hand side and right hand side equals, so that means we did something right. Our next exercise is lump sum sale. Okay, this is when you buy two or more equipment together and you need to know how much each one costs. So in this exercise, we bought land, building, and equipment together. Okay, and in order to find the allocation, you need to know your fair market value, or what will be called the appraisal value. So it's the same as fair market value. Okay, so I'm going to begin by finding my lump sum sale. So I bought it for 306,000. Okay, and then I need to know, because I have these numbers, I'm going to use that to find the percentage of the my appraisal value and multiply that one by the lump sum sale. Okay, so let's do practically. So my appraisal value for land is $60,000. So that is right here, 60,000. And my appraisal value for building is 220,000. And for equipment is 80,000. Okay, so the total for the appraisal value will be 360,000. So this is my appraisal value, 360,000. And in order to find the allocation, I need to find the percentage of this and multiply by that percentage of each and multiply by my lump sum sale. So that's what I'm going to do. Okay. So the allocation for land, I'm going to begin by finding my appraisal value, which is 60,000. And then my total appraisal value will be 360,000. And I'm going to divide these two together. So I find 17%. So that 17% will multiply by my lump sum sale. And my lump sum sale is 306,000. Okay, and in order to find the allocation, I multiply this percentage by my lump sum sale. So that's 51,000. I'm going to do the same for allocation for building. Okay, so what is my fair market value for building? That is 20,000. And then the total appraisal value is this 260,000. And now I find the percentage this divided by that. That gives me 61%. Once I find that, I'm going to multiply by my lump sum sale to give me the allocation and multiply by that, and I have that. Let's do the same thing for equipment. What is my appraisal value? 80,000, and then my total appraisal value is that, and then I find a percentage. So that one divided by the total appraisal value, and then I need my lump sum sale to multiply to find the allocation. I multiply that one, and then 68,000. Okay, if you want to make sure if that is right, you can do that by adding all the allocation together. So allocation for equipment, allocation for building, and then allocation for land. Okay, that gives you 306,000. So you know the allocation you did is equal to this one right here. So land actually costed 51,187 and 68,000 for your allocations. Our next exercise is on depreciation, but we are going to do it for 3 methods. So we have a straight line method here, number of units right here, unit of production and double decline. Okay. So in order to know, okay, how much you can depreciate, let's start with straight line. You need to know how much you can depreciate. Okay. Straight line means it's the same every year. Okay. So you need to first begin by finding your historical cost. That's how much you bought it. And in this case, our historical cost is 101,250, 201,250. Okay. And then subtract your residual value. So my residual value is right here, residual value, 7,500. And then the remaining, as you subtract, remaining this minus that gives you, okay, so that is how much you can depreciate. So you shouldn't depreciate less than or more than this. Okay, it can be less than, but it shouldn't be more than 39,750. Okay, good. So let's do that for depreciation. Let's start with a straight line. Straight line. Okay, with straight line, I'm going to find my useful years. My useful years is 3 years, right? Useful life is 3 years. I just need this to be numbered. Okay, 3 years. So there are 2 ways you can do it. You can find a rate and multiply by the depreciation cost, or you can take the depreciation cost and divide that by 3. Okay, so if you want to find your rate, you can take 1 and divide by 3. Okay, so that's 33%, because with that's the same as 100% divided by 3, because this is 100% and you're going to divide it by 3, and that's 33%. So each year it depreciates 33%. Okay, so if we do that, we can take this 33% multiplied by the depreciation cost. So that is 31,250 for a year, and it's going to be each year, it's going to be the same. So I'm just going to do that for all the years. And I'm going to sum them up. So we have 93,750, which is the same as this. It didn't depreciate more than that. There's another way you can do that. You can take your depreciation cost right here and divide that by 3. It's the same as doing 33%. So each year is going to depreciate by 31,250. So that is our what do we call it? Straight line depreciation. Unit of production is similar to straight line, but straight line is in years and unit of production is in hours or activities. Okay, and we know the useful life for straight line was 3 years, but straight unit of production was 25,000. Okay, so that is 25,000. We'll put it there, and this is not in dollars, but in number. Okay, so we have what, 25,000. So for the whole 3 years, or for the whole life of the equipment, it can work up to 25,000 operating hours. So we need to know how much will each cost. Okay, how much would one cost? 1 hour. How much would 1 hour cost? Okay, and if our depreciation is this one, we can only depreciate that. We divide that by the 25,000 hours. So each hour will cost $3.75 of depreciation. Okay, so let's see. In the first year, how much hours did we use? It says right here we used 9,500 in 2010, 8400 in 2011 and 7100 in 2012. Okay, so we are going to multiply those hours. Okay, so we use 9500 multiplied by 3.7. Okay, that is for the first year. The second year, we will take 8400 multiplied by the same dollar amount. Okay, and then we take the last one, 7100, and then we multiply by 3.75. Okay, so if we sum them up, we realize we have 93,750, which is the depreciation cost. Double declining is simply double of the straight line. Okay, so you need to find the rate of the double declining. Okay, and if the straight line is 33%, double declining rate will be times 2. So this one, twice of that. Okay, so double declining rate is 67%. The only difference is you start depreciating it from the historical cost. Okay, with straight line, we depreciated it from the depreciation cost. But in this case, we are going to start from the historical cost. But there's one thing also I need to keep track of. I need to keep track of my book value because I do not want to depreciate it and have a book value less than this amount. It shouldn't be. Okay, so this is what we're going to begin with. We take our 67% multiplied by our historical cost. So the first year it depreciated 67,500, and I need to find how much is left. Okay, so I take my historical cost minus my depreciation. So that is my book value after the first year. And then the second year, I'm going to multiply this by that. That's how much it's depreciated. So we are depreciating it based on the book value. Okay, and so at the end of the second year, how much is it left? I take the book value minus how much I've depreciated. So I have 11,250. And note, in the third year, if I use this, my book value will be less than 7,500, and I don't want that to happen. So I'm going to take, and for instance, let's do an example. If I take this, multiply by that, I will have 7,500, and my book value remaining will be 3,750, which is not what I want. I want to have 7,500 as my book value. Okay. So in order to do that, you only have to take your 7,500. So it has to be 7,500. So I take my book value minus what it has to be, and that's my depreciation cost. So if I sum them up, that gives me 93,750 for the 3 years. Okay, so it's the same as the depreciation cost. So we know that depreciation did not go above the depreciation cost for the whole 3 years. Okay, our next problem is disposal of fixed asset. Okay, disposal just means we are selling or you are getting rid of. Whatever you do, you are just, whether you sell or you give it to someone, you are getting rid of. Okay, but in this case, we are selling it. Okay, but we have been asked to find a depreciation for those 3 years. Okay, so we have 2009, 2010, and 2011. So I'm dealing with 3 years. Okay, so in order to find depreciation for each year, I need to know my historical cost minus my depreciation, minus my residual value, just like we did here, and I know my depreciation cost. Okay, so in order to find for each year, I take my 425,000, which is my historical cost, minus my residual value, 65,000. And I divide that by 9 because it's going to last for 9 years. Okay. Okay, I didn't put the divided here. Okay. So each year we're going to depreciate by 40,000. And if I want to know how much depreciation will be for the entire 3 years, I just take this and multiply by 3. Okay, so for the entire 3 years, depreciation cost will be 120,000. So that is for A. Okay, let's bring this down and do B. What is the book value of the equipment when generated? Okay, so after the 3 years, what is the book value? And the book value is my historical cost, 425,000, minus how much I have depreciated. Okay, so I know 305,000 is my book value. Good. C. Assuming that the equipment was sold on January 9th, so in the third year, or after the 3 years, in the fourth year, the equipment was sold for 290,000. Okay. Now, straight away, you need to know whether you are losing or gaining. Okay. Here, your equipment is worth this, but you are selling it for 290,000. So you are losing 15,000. So you know how much you are losing. Okay. But journal entry is a little bit tricky and different. Okay. So now, as you said, what am I receiving? You are receiving cash, and the cash is an amount of 290,000. Okay, what are you selling? You are selling equipment. Remember, equipment is always debit, but because we are getting rid of it, we are going to credit it. That's 425,000. Okay, the reason we use 425,000 and not the book value is that in our books, we have equipment worth 425,000. So that's how we want, what we want to get rid of. But we also need to get rid of the accumulated depreciation, which is 120,000. Okay. So now right here, we know on our left-hand side, we have, how much is it on our left-hand side? 41,000, 410,000, and on our right-hand side, we have 225,000. So we need to make sure our left-hand side is equal to our right-hand side. So in order to do that, we take this minus that, and then we have the 15,000 that I projected that will be. So our loss on equipment is 15,000 for the general entry. Okay, let's go ahead and do the last one, which is the D, assuming that we sold it for 310,000. Okay, so now how much are you going to gain? Okay, are you going to gain or are you going to lose? You are going to gain about 5,000 because it's worth 5,000, but you sold it for 310,000. We're going to do the same thing as we did in the previous one. So we are receiving a cash of 310,000, and then we are getting a quick rate of equipment for 425,000. Accumulated depreciation is 120,000. Okay, so now we have here everything on the left is greater than everything on the right. So we need to make sure what is on the right balances. Okay, so here I'm going to take this plus that, and then minus the one on the right hand side. So we have 5,000. So we know left hand side 430 and right hand side. So this is a gain on sale. So we have a gain on sale of $5,000. In our next problem, we are going to form a partnership, okay, between two people. And in this case, Amber Moss and Toya Pell. Okay, all right, whatever the name is, but we have to generalize the partnership entry for Moss. Okay, so Moss Investments. That's what we're going to do. Okay, so first we are going to look at what Moss is bringing and what is accepted. So we have the book value of what he's bringing, and we have the market value. The market value is what the partnership have agreed on. Okay, so let's begin with the things that Moss is bringing. So we know Moss is bringing a cash. Okay, so the things listed here bringing a cash of 15,000. So we have going to list our 15,000 here. Okay, what else is he bringing? He's bringing account receivable. Okay, right here, account receivable with a face value of 159,000. Okay, he's also bringing, after account receivable, he's also bringing allowance for doubtful account for 9,700. So we have 9,700, which is a credit account. Okay, and then he brings merchandise inventory with 100,000. So I'm going to type my 100,000, which is debit. Okay, and then he's also bringing equipment right here, and the equipment is worth 155,000 right here. Okay, but the equipment comes with accumulated depreciation. Okay, and the accumulated depreciation is 100,000. Okay, now let's look at the market value. What did the partnership agree on? Okay, the partnership agreed that 6,000 of the account receivable. By the way, cash, you cannot do anything about cash. So cash, $1. If you have $1 in your pocket, market value right now is $1, unless there's time value of money and then you wait for the next year. But that's another whole topic. Okay, so there'll still be $15,000. And then you notice that the partnership agreed that 6,000 is worthless. Okay, so 6,000 of the account receivable is completely worthless. So we are going to take this and subtract 6,000. So that's 153,000 what the company has agreed. And what else did they say? And that 11,400 is reasonable allowance for uncollectible. So the company says, no, not 9,700, but 11,400 is reasonable. Okay, so merchandise inventory, what did the company agree on merchandise inventory? Recorded the current price of 91,450. Okay, so this is what the company, well, it's a company, yeah, it's a company. The partnership agreed that only 91,450 should be recorded. So is debit account 1,450. And then equipment. And that equipment is to be valued at 62,500. Okay, so right here, 62,500. Okay. What about accumulated depreciation? No. So when you're doing a partnership, the only thing that does not carry over is accumulated depreciation. You ignore accumulated depreciation. Okay, because the book value, this minus that, the equipment minus the depreciation is what we have already concluded. You don't carry accumulated depreciation for a partnership. Okay, now we are going to do the journal entry for Moss. Okay, and we see how much Moss has for the in the partnership. Okay, so we begin by Moss has a cash. Okay, and the cash we are only going to take there is the same amount, but we take the what the company agreed, the market value. So the market value is what the partnership agreed. Partnership agreed. Okay, and then account receivable. What did the partnership agree? The partnership agreed that account receivable is 153,000. Okay. Allowance for doubtful accounts, the partnership agreed that it should be 11,400. Okay. And then merchandise inventory, although he's bringing 100,000, the partnership agreed at 91,400. And also his equipment is now going to be born again without any accumulated depreciation, which is 62,500. So we need to find out how much his credit is. So, and we know we're going to take everything on the left minus everything on the right, because this is a credit account. That is what we're going to do. Okay, so we are going to sum up everything here minus everything here. There's only one thing there. Okay, and that is 310,000, and then we know our total check is this and that. Okay, so this is Amobro's capital, in the partnership. Okay, every business activity brings income or loss. Okay, so in case of partnership, the income or loss has to be shared among the partners. So in this exercise, we are going to see or work through how we would divide the net income or loss based on the agreement. Okay, so I'm going to begin by, we have these two people. We have Jennifer. Okay, we have Jennifer here, and then we have Megan. Okay, Megan Trout. If our partnership, this is investing 330,000 and one at 10,000. Okay, so I'm just going to list this information with Megan's and so Jennifer's investment was 330,000. Okay, and Megan's investment is 110,000. Okay, so the total investment for those two will be to add these two together. Okay, so we have that information. Determine their participation in your year's net income. Okay, so our net income is 420,000. Okay, so we know that. Okay, so A, no agreement concerning division of net income. Okay, so here there's no agreement. If there's no agreement, then no one has to be cheated. So that means whenever there's no agreement, the net income should be shared equally. So what is our total net income? I already have the template here, so we can copy that and follow that on your test. Okay. So our total net income is 420,000. Okay, so we are going to share it equally. So this divided by 2. Okay, this divided by 2. So we have here, and then we'll have this one divided by 2 as well. So according to A, Jennifer and Megan will earn equal amount on the net operating income, okay, or on the net income. B, we have a different scenario. What is happening with B? Let's see, divided in the ratio, divided in the ratio of capital investment. Okay, so we are going to find the ratio of Jennifer's investment, and that is how much she's going to get out of the net income. Okay, I'm going to find Jennifer's ratio. If Jennifer is investing this and the total investment is this, okay, her percentage is 75%, and automatically we know that Megan's will be 25% because she's investing this divided by the total. So Megan's investments is 25%. So out of the total investment, she invested 25%, that one invested 25%. So that is how we're going to share the net income among them based on their ratio. Okay, so our net income is 420,000. So I put it here. And then Jennifer will get 75% multiplied by 420,000. And then Megan will get this one multiplied by 420,000. I didn't multiply, obviously. Multiply by 420,000. Sorry, multiply by the percentage. So we have 420,000, this one, multiplied by the percentage, which is 25%. So if you add those two together, this plus that, the total net income is 420,000. So we are going to do this in a different way in C. Okay, we are not going to start with the 420,000 over there. So we have Jennifer and Megan right here again, but we have a different rule. We have a different agreement in this time. Okay, so C says interest at, okay, so interest, we're going to give them interest at 8% on original investments. So we are going to give each of them 8% on their investments. Okay, so this is how we're going to be. Jennifer will take 8%. So we have 8% multiplied by her investment. Her investment was 330,000. Okay, Megan is also going to take 8% multiplied by her investment, 110,000. So the total that we have shared among these two girls is 35,200. Okay, so that's the first agreement. Okay, and then the second, and the remainder divided into two-thirds. Okay, so we need to find the total allowance we have given them. So our total allowance will be this one, and we can just drag this one all over here. Okay, this is going to make sense in our next one. Okay, so that's how much we have given them for their total allowance. Remember, the allowance is coming out of the net income for the year. Okay, so if we have shared 35,200 for them, how much is left out of the net income? Okay, so that means we will take our net income 420,000 minus 35,200. Okay, so that is how much is left, and we are going to divide the remaining two-thirds. Okay, two-thirds. This two-thirds we just simply means Jennifer is going to get 2 out of 5, and then Megan is going to get 3 out of 5. Okay, so we are going to take 2 divided by 5 multiplied by the remaining income. Okay, we are going to do the same for Megan. Megan is having 3 divided by 5 multiplied by the net income. Okay, now let's see how much each of them got. Okay, their total allocation, net income allocation. So we have, they got allowance plus this, so that is her total. We drag this, that's her total. And this one should give us 420,000. Yes, it did. Or you can double check by also adding this plus that, and you still have 420,000. So that is how you divide the income based on this agreement. The next scenario, which is D, we are going to give them 50,000 and 70,000 respectively as salary allowance. So Jennifer and Megan, we are going to start by dashing them their salary allowance, which is 50,000 for Jennifer and 70,000 for Megan. And then the total for those two will be that, okay? And their total allowance, if I want to do this again, that's the total allowance, and I just drag this all the way here, okay? Now, what is the remaining? It says, what do we do with the remaining? It says the remaining is divided equally, okay? So we're going to divide the remaining equal. How much is remaining? If we had a net income of 420 and we have distributed 120,000, the remaining is 33,000. Okay, so we are going to divide it equally among them. So we take this divided by 2, and then we take this one 2 divided by 2. That's the remaining. Okay, so now we are going to add their total allowance that they got. So Megan had total allowance, salary allowance plus the remaining. Okay, 200,000, 200,000, and this one should be 420,000. You can double check by adding this plus that, that gives 420,000. So once you build in the formula, you can just copy and or drag. Okay. Now we have the fifth scenario. Here we are going to give them the social allowance rate 8%, all right, and then they are going to get salary, and then they are going to the remainder will be divided equally. Okay, so let's begin and do the same process again. Allowance 8% allowance on the investment. So Megan will have 8% multiplied by her investment, which is right here. Okay, and then Megan will also have 8% multiplied by her investment, which is right here. Be careful which one you choose. Okay, so that it is for their allowance. And the next one says salary. We are going to give them salary of 50,000. So 50,000, and then Megan will have 70,000. Okay, so we're going to add those two together. That's it. Okay, so their total allowance, we are going to add those two together to find their total allowance. Megan had 8% of that, and then 50,000. That's her total allowance. Okay, so we have distributed total of 155,200 out of 420,000 net income. So we need to find the remaining. How much is remaining? So the remaining will be the 420,000 minus how much we have distributed. Okay, now we are going to share this equally because that is what the agreement said. The agreement says divide equally. Okay, so we are going to have this divided by 2. We're going to have the same thing divided by 2, the remaining. Okay, now what is their total allocation for the net income? To find Jennifer's, you take Jennifer's total allowance plus the remaining, how much she got on the remaining, and you drag it all the way, and you have 420,000. Or you can double check by taking this and adding this, it gives you the same 420,000. So be careful, and you can pause the video and watch this part. It's very critical. But we have to continue anyway. Let's talk about stocks transaction. Okay, one thing you need to understand and remember always, when it says issue, issue means sold. So whenever you hear issue, and at means how much you sold it at. Okay, how much you sold it. That necessarily doesn't mean that is the worth of the stock you are selling. Okay, let's continue and do journal entry for these ones. Okay. So in this scenario, we have the data written already, right? But it says in A, issued 50,000 shares of common stock at, remember, notice the at 50. Okay, receiving cash. Okay, so we know cash is coming in. We sold 50,000 multiplied by 20. That's how much cash is going in. Okay, it's coming in. But what is the worth of the common stock? Okay, we need to know how much the common stock is worth. You notice here, common stock right here says 15 par. Okay, so the par is how much it's worth. Although we sold 50,000 at 20, it's only worth $15, not 20. Okay, we are going to take 50,000 multiply by $15. So that is how much the stockholders or those that are purchasing are getting. Okay, so now we had a profit. Okay, because we sold it more than the par value. Okay, so this is sold at premium. When you sell it more than the par value is premium, that is more. I shouldn't be doing this. This is a test. Okay. So now we need to find the difference. So we take the debit minus the credit. That's 250,000. There's another way you can know if that is right. That is, you take your 50,000, you sold 50,000, multiply by what is the difference. The difference is it is where you sold it at 20, but it is worth 15. Okay, and then you have your 250,000, the same amount as the difference. Okay, In the second scenario, get rid of this to avoid confusion. Oops. Okay. In the second scenario, we are issuing this, we are selling again preferred stock. In this case, we are selling preferred stock, okay? And we are selling it at, okay, notice the at 92, okay? So we are selling 10,000 preferred stock at 92. So that's how much cash we are getting into the company. But what is the worth of the preferred stock? The preferred stock will be 10,000, all right? But multiplied by what is preferred stock? 75. It's only worth 75. Okay, so we need to know our paid in capital for this one. So we take debit minus credit, and then everything on the left and right equals. Or you can do that by 10,000 multiplied by, you saw this for 92, but it's only worth 75. Okay, you still have 172,000, 170,000. Okay, so now let's move on quickly to see you purchase a treasury stock. Okay, so in this case, the company is buying a treasury stock. Okay, or buying a stock, maybe it's the common stock. Okay, I have the 6 in there, but I'll explain really quickly. So we purchased 30,000, 30,000 for $480,000. So I'm going to put my 480,000 here, all right? And then how much is cash? I purchased for 480,000. Okay, but you want to know what is the worth of the treasury stock, okay? What is the worth? Okay, if you purchase it at 480,000 and then you purchase only 30,000, so you divide by 30,000, okay? So each treasury stock, this treasury stock is worth $16. That's why I had the 16 here at the pound. That's how I got it. Okay, so now we have D. You sold 15,000 shares of treasury stock. Okay, how are we going to do the selling? And you know 300 and you sold 15,000. 322,500 is how much is coming in. So cash doesn't change. So 322,500 is how much cash is coming in. But what is the worth of the treasury stock? Okay, you know the treasury stock is worth $16. So you're going to take your 15,000 multiply by $16. Okay? So the treasury stock is worth 240,000, and this is more than the what is worth. You sold it at premium. So you're going to have a paid-in capital on your treasury stock. Okay, so you take this minus that, and you have your treasury stock. Okay, now let's move on to the E. You sold that treasury stock. Okay, still treasury stock, but you sold it for 155,000. Let's see how we can do that. We know cash is automatically is the same. It's not going to change. 155,000. And then by your treasury stock, how much is it worth? We know that this is worth $16 per share. Okay, it is worth $16 per share. So we will have 10,000 multiplied by the $16. Okay, so 160,000. We should sell it at 160,000. In this case, we sold it at less. Okay, so that is we are selling it at discount. Okay, so we will take the right minus the left. Okay, and then we have everything equal on the left and the right hand side. Good. When you have stocks, you are going to pay dividends. Okay. So in order to do that, you need to know, you need to declare dividends, you need to record and pay. Okay, so here, identify the 3 significant dates. Okay, so we have a date of declaration. Okay, what is the journal entry for date of declaration? And that is cash dividends will be debited and then cash dividend payable will be credited. Or there's another way you can do that. And that will be a retained earning because this cash dividends eventually will go into retained earning. Okay, so you can take it straight up to retained earning, or you can just let it pass through cash dividends. Okay, there's a second date, date of records. In the date of record, you don't do anything, no entry. Okay, and then the date of payment, that is when you are going to credit cash because cash is going out. You are going to debit the cash dividend payable to get rid of your debt. So when you declare, now you are liable. You have to pay that. That's liable money you have to pay. And when you pay, then you have to get rid of that. Okay. Now that you know what to do when you declare and pay, you need to know how to pay as well, how to allocate the amount. So I'll take you back here, and you see there is a 2% here. Okay, that is what dividends is about. Okay, so what you are paying them, if you give them dividends, that will be 2% times this times the number of shares outstanding. In this case, 20,000 is outstanding. So let's solve an example how we divide um, cumulative what do I say? How we divide cumulative dividends. That's the word I was looking for. Okay, good. So in this case, we have this company buys and then so many things that we don't actually need. But if I go straight forward with you, in each year, okay, 2007, they declared this. So we have the numbers here. Okay, we have been given everything that's there. It's here. 2007, they declared that and then that. Okay. But during the entire year, the stock of the company was 20,000. Okay, 20,000 cumulative, that's for preferred, and then 50,000 for common shares. Okay. When you declare dividends and you are paying, you paid preferred first. And if anything is left, then it goes to common. If nothing is left, common shares, they have nothing. Common stock shareholders, they will receive nothing. Okay, so let's see how much we have to pay them each year. Okay, so having this one here, preferred stock, and then I have my common stock right here. Okay, so I need to know how many shares I have. Okay, for my preferred stock. Preferred stock I have here, it says 20,000 shares. So I put my 20,000 here. And then what is my dividends? You know, the percentage is the dividend. The dividends is 2% right here. Okay, so I put my 2% here. And now, what's my par value? The par value is 75. So $75 by 75 here. Okay, so how much do I have to pay them each year? I need to pay them this, multiply by that, multiply by this. Okay, so each year I need to pay them $30,000 for preferred stock. Good, common stock, they don't really matter, but depending on how much preferred stock get. But let's look at their shares. How much shares do they have in common stock? 50,000 right here. So I will take my 50,000 here, preferred stock. And then dividends, we don't have any dividend declared for them because they get paid based on how much is left after we pay preferred stock. But the par value, we just put it there, which is 5. Okay. And then how much do we pay them every year? How much are they entitled every year? And that is whatever is remaining after we pay preferred stock. So we are going to use this knowledge to distribute or find how much we pay preferred stock and how much we should pay common stock. Let me move this over here to see if it will work. Let me see, that is okay. But now I'm going to list everything. I'm going to make this same table right here. So that is what I have here. Okay, so from each year, okay, now I'm going to list them so that will be easier for me. So I will not need this anymore because I have more my information here. Okay, so year one, we are going to declare $8,000. Okay, and then year two, we declare $24,000. Year three, 2009, we declare $60,000. Year four, which is 2010. Okay, I have the years here. We declare $75,000. And then we declare $80,000, and then we declare $98,000. So I just copied and paste what is here because I'm not gonna need, I don't wanna go back and forth anymore. Okay. Now that I have that, okay, preferred dividends. Okay, we know year one, we need to pay them $30,000 right here. But do we have enough money to pay them? What amount did we declare? We declare only 8,000. So that means they are only going to get 8,000. Okay, and the earning per share for each of them will be the amount they are getting divided by the total shares. So that's earning per share. So each preferred holder or preferred stock shareholder will get $0.4. But arrears just means how much we are owing them. Okay, we needed to pay them 30,000, but we were only able to pay 8,000. So we are owing them how much we needed to pay them minus how much we have paid them. Okay, so we are owing them 22,000. How much will common stock get? 0, because we are even owing preferred stockholders. So, and their earning per share will be how much they got divided by the total shares, which is 0 still. And in the second year, we declared 24,000. And notice, you can tell that 24,000 cannot pay 30,000 and 22,000, 52,000. We didn't have enough money to pay preferred stock, everything. So whatever we owe them carries over to the next year. Okay, so in this case, because it's less, we are going to give all the 24,000 to them. And then the earning per share will be the same thing, having 24,000 divided by 20,000 shareholders. Okay, how much are we owing them now? We owe them this from the last year, and we should have paid them about 30,000 in addition, but we were only able to pay 24,000. So we owe them 28,000 at the moment, at the end of second year. Common stock will have nothing because nothing is left, and their preferred or any per share will be 0 as well, because 0 divided by the number of shares is 0. Okay, now in the third year, we declared $60,000. Okay, now we are owing them 28,000 plus 30,000, which is 58,000. So that means we can pay all the 58,000. We can pay them yearly amount plus how much we were owing them. We can pay the 50,000, 58,000. Now we were going to have this one divided by the number of shares. So in the third year, each shareholder had $2.9. Now, how much do we have remaining that we are owing them? Okay, that will be what we were owing them, this one, plus what we're supposed to pay, and then minus what we paid. Okay, so we are owing them 0 in third year. Now, how much will common stockholders have? Common stockholders will have what is remaining after we have paid preferred stock. And we declared this and we paid this, so minus what we paid. So common stockholders will have 2,000 dividends, and earning per share will be the 2,000 divided by the number of shares at 0.04. That's how much they are getting. In the third year, we declared 75,000. Okay, we are not owing these people anymore. So we are just going to pay them the 30,000. Okay, and then the earning per share will be the 30,000 divided by 20,000. We have that, and then the arrears will be 0 because we had to pay them this. We didn't owe them anything, and we were able to pay that, so we have 0. Okay, now what will dividends for common stock be? That will be what we declared minus what we paid preferred. That's the remaining, and then their earning per share will be this, what they earn divided by the number of shares, because we share it among them. So that is 0.90 per each year. Okay, and then the next one, we are not owing them anything, so we are just going to pay 30,000. We have enough money to pay that, so we pay the 30,000, and then the earning per share will be 30,000 divided by the number of shares, and then arrears will be 0 because we are not owing them anything. We're supposed to pay this, and we pay that, so it's 0. And then common stockholders will have 50,000, which is 80,000 minus the 30,000 we paid, 50,000 remaining, and then the earning per share will be the 50,000 divided by that 50,000, so $1 each. In the last year, we had 98,000, so we will be able to pay each year how much we need to pay. And then their earning per share will be the same as the previous year. What is there? Okay, Earning per share should be divided by the total shares, okay, $1.5, and we are not owing them anything. This one minus, and we pay that. And then the common stockholders are feeling better with themselves this time because they are going to get 98 minus 30, which is 68,000. And then earning per share will be how much they got divided by the number of shares, which is 1.36. So that is how you do, what do we call it? Earning per share. That is how you distributed a dividend. Dividends, remember always that you need to pay preferred stock first. Okay, and whatever is left goes to common stock. If nothing is left, common stock gets nothing. Okay. And in the next one, I'm not going to do it, but feel free to pause it and watch it here. Okay, so this is an example. Try it and see if it matches with what I had here. That's A and B. And we also have forming a partnership. You can also pause this and watch it right here as well, and see if it matches with what I did here. We have another dividend scenario. This is different, okay? So you can pause the video and also watch it to see if your answer matches with mine. As I've always said, there are so many ways to do accounting, but whichever way works for you, keep practicing, and good luck on your test.